All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Another very volatile day out there in the market. I have S&P futures up here, and we went from after the market yesterday to seeing futures drop to 26.95 to popping all the way up to 28.80. Just a move that if we had a month where this was the move, they'd be talking about that was an incredibly bullish month for the market. We've had months that have not had this much movement, and that's the movement that S&P futures had between the U.S. market close and 12 hours later. It took 12 hours for that move. Then in the next 12 hours, whoosh, back down we go. Massive move. Where if we had a month where the market did what it did here in the last 12 hours, everyone would be saying, "Man, this was an incredible month. There was tons of movement, tons of volatility, out there and chop." That is the nature of the market that we are in right now. It is one of the biggest moving markets that we have seen in a while. Now we have seen far more volatile than this on a percentage basis, but when you wake up and you see a headline that says "worst day in 12 years," is basically what yesterday was for the markets. Something different is going on. This is not your run-of-the-mill pullback. This is not your run-of-the-mill correction. This is not something where you can pull up the fundamentals on something and go, "Well, the margins on this are blah, blah." No. It's one of those where the fear and the panic reign, and they're on both sides. And I can't stress this enough, that they're on both sides, because the buyers or those waiting to sit and buy are sitting there panicked, worried about missing it, and those that are being forced out can't get out the door fast enough. And so these types of environments create panic on both sides, and that is not going away here today in any way, shape, or form here in the market. So this afternoon we don't have any challenge trades, but I want to speak to one of the most what's the right word here, relevant topics on traders' minds is where's the bottom, and go take a look at the anatomy of a bottom and kind of show you some chart perspective here, which helps from an investor standpoint but doesn't really help from a trader standpoint. And then go take a look at some of these and talk about the best time for options, because buying options yesterday didn't necessarily pay off for most stocks. Some stocks have moved enough to move the options, but in many cases there are stocks out there where the stock is up today, options are down. At least on the call side, the call options are down even though the stock is higher. And if the stock goes even semi-flat tomorrow, those option values are going to deflate in a very big way. But overall, we'll go take a look at that. But again, for the challenge, there are no new signals. Let me show you some of the crossover action here. Let's come in and I'll bring up the bearish crossover list. You can see Walgreens on this list. This is one that had an upside crossover and on Monday, I believe, and has a bearish crossover here today, but was no signal on the up, no signal on the way down, as the consolidation risk is very high there for Walgreens. And then, market up today, we're going to have some upside 3-7 crossovers. Nope, not a single one. And that's why there are no triggers. There's just no crossovers out there for the market. We had a bunch of downside crossovers yesterday, but consolidation risk very high when it came here to those. So this current market. Here we are. Here's the S&P. We pull off all our indicators. This is what it looks like. We have this big drop, and then we have this monster pop, 28.50 up to 31.25. I mean, that rally that we saw in a matter of 1, 2, 3, 4 days was an absolute monster rally, only to be erased 4 days later by another crushing downside leg. From day one of this pullback, we've talked about the biggest rallies happen during these pullback times. You can look at the biggest up days in the history of the market. They happen in bear market conditions. And we are in bear market conditions in every way, shape, and form. 100-point rally overnight in S&P futures, 185-point rally in S&P futures. That's what you get in bear markets, not bull markets, and that doesn't normally signal a bull market coming in and of itself. But this sell-off here in the market is very different than the sell-off in May, than the sell-off in August, than the sell-off in September and October. This is not your run-of-the-mill correction. This is very different. For the market to be sold off to this magnitude this quickly, something different has to happen. And we know what the headlines are and the fear with the coronavirus. And I know some people look at it and say, not a big deal. It'll come, it'll go, and it'll pass. Other people look at it like it could be the end of the world pandemic. There are all sorts of opinions with it. But one thing that is certain right now is investors do not know how to price in the economic effect of the coronavirus. And not from a death toll standpoint, but from an economic activity standpoint. You take, for example, Italy, which is canceling their Serie A games, their soccer, football games, and stadiums empty. You have the NBA here in the U.S. talking about playing in front of no fans, basically empty arenas. Those, you talk about companies saying, hey, employees stay home. Some of this is a tip of the iceberg. Is it overreaction? Different opinions abound about it out there, but the reality is it's bringing economic activity down, and bringing economic activity down in a very big way, and in a way that could get significantly worse when it comes down to it. I mean, you've seen probably the images of Wuhan in China and all of that, where the city is basically empty, size of New York City, and nobody's out there. And you think about the economic impact there, and there's a sizable one. And so investors do not know how to quantify that. That's where they struggle, and that's where some of the extreme volatility comes in, because they do not know how to quantify it. And what does an interest rate cut mean? Well, who knows? What does a tax cut mean? Well, who knows? Right? Those types of things, they could mean very different things depending on what happens overall with the outcome of the coronavirus. So anyway, we're in a very uncertain time, and that is very normal when we are talking about these types of pullbacks, that times are uncertain. There isn't a certainty factor that we can put in to say, well, duh, everybody knows blah, 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 so this should be the reaction. These are times of significant unknown. And so let's go back, take a look at 3 other times where the unknown was significant, where the price action was historic. And let's just kind of see how investors played it out during those times. Let's start with 1987. Here's the S&P in 1987. In 1987, a great year for the market. Market going on up, has a little pullback in the summer, breaks into some new highs. You see some similarities between the market right now and what it did back here in 1987. Then it had a pullback. All right, a nice little pullback, a little recovery. Everything's great, grand, and wonderful, right? Nope. Boom. In about the same pace as what we have seen here in the U.S. right now, in terms of market dynamic and speed of drop. We saw this 1987 crash, and it was one where investors woke up and prices has changed dramatically, and a lot of uncertainty, a lot of unknown. A lot of fear. How did it play out? Was it, well, here's the magic bottom and go buy here because it's the magic bottom and now the Bulls are in charge and go, go, go? Is that how it played on out? No, clearly no. Clearly no. We had an immediate bounce, very strong bounce. Then we had another strong dip and another strong bounce and another big dip and another big bounce. We saw very choppy action. We saw more selling on the downside, then a big rally. Everything's safe. Everything's great, grand, and wonderful. And then look at this down day right here. And this is massive. The market took a long time to shake out. To really shake out in a big way. And different stocks did different things. You take a look at something like a Bank of America and how it traded during this time. It came down, hit a new low. This is very common to see, with these, but that didn't prevent it from going back to new highs later on the next year. What about IBM? IBM's been around forever. Look at this. Big drop. Okay, big pop, big drop, big pop, up, down, all around. Took a long time to sort out. The 1987 drop was bigger than what we saw yesterday. What we saw yesterday was only 7%. And we could still be in for a 1987 style drop. When we come in and we price or we plot the S&P, here. Take a look at the drop ahead of the big crash. This was similar to what we saw yesterday in terms of magnitude of move. So when we look at the market right now, the risk factor for a big crash is significantly greater than it normally is. Very rarely do we see stocks move to a new high and then all of a sudden just crash. No, they tend to crash after big sell-offs. That's when we get the crash. Speaking of crash, let's go into 2010. Here we go, 2010. We got a correction here in January, rally March, April, stocks at new highs. Then we get some heavy selling come in here in May, and then we get this flash crash day. This is that day where the market just absolutely got slammed. I just remember watching the computer and my charts that day, and I'm sitting there staring at it, just going, "Wow, this is incredible." In terms of the pace and the movement of the market, was just something we hadn't seen in a very long time. It didn't compare to the pullback we saw in January. This was something different. This was something that was greater than the normal pullbacks. There's something structural. There's a fear, panic element here in it. That was on a Thursday. Friday market, was down a little that day, but had a little bit of bounce in a few things. And then the next Monday, the market gapped up huge, almost 5% as China came out and issued some quantitative easing. And I remember the news on that day talking, hey, flash crash over. We've had the proper response from government officials. Everything's great, grand, wonderful. And the market stayed up here for 2 days. And then, boom. Within another week and a half, back to a new low. Big rally. All right, here we go. Everything's bullish now, right? We've had the big rally. Oh, no, here we go. Big drop. New low. Then another massive pop. Oh, another big drop, higher low, and then off we go. But take a look at the time period here. This is from May to September, basically, where it took a while to sort out. And in the meantime, big pops, big drops along the way. After this kind of wow type of event. Then we get into 2011, and we get another wow event. Take a look at this sell-off. This was a monster sell-off. And this isn't one where we had a big rebound in between. This was just sell, 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 sell. and it created huge margin calls. It created a lot of issues for investors. It was it was deeper in terms of magnitude than the flash crash, and it was one where it had investors looking around going, "Man, this can't be normal." And you see how it played out afterwards. What happened? Weeks, months took to go with big rallies and big drops and big pops and drops across the way, and that became a little bit more normal going forward. You'll notice that after these big abrupt events, we do not have this V-shaped recovery where, oh, bottom's in. It's now the bull's turn for everything to go up. We don't get that. That is not normal. That is not something we see when we have this magnitude of correction. A V-shaped recovery is what we see on more shallow corrections, like here in February of 2011. We get a little more shallow correction, right? Then we get a V-shaped recovery. We don't get V-shaped recoveries on these really dramatic sell-offs that shake the market to a different degree. Here's 2007. Down, down, down we go. Then we get a big pop because the Fed cuts the rates. Then we get a new drop to new lows. And then we get this big reversal candle right here before the market recovers. And this one doesn't take as long. This is only about a 3-month process. And we get a big uptick, but you can see some of the big sell that came in after. There were still heavy sell periods. But take a look at this candle right here, and the reason I'm showing this chart is because of this candle. This candle is one where it happened without any real news. In fact, that morning, the news was pretty bad. There was some economic data that came out that wasn't very good, and we saw the market sell it aggressively. And I remember sitting there, I was watching the market on that day, and, for those of you who remember Carl, we were sitting there watching the market together that day, and it just starts going. There's no news. We can't find any news. We can't find any reports because there isn't any. We just start seeing money come in on, what was a pretty bad day. And it was just one of those where we normally do not get this picture perfect of a bottom, but on that day we did. And this is what I refer to as a bad news bottom. And there are three things that I'm looking for in terms of, is the bottom in? Number one is this type of action. Is there a bad news bottom where we just get awful news, bottom comes, and then the price action is opposite of the news? So far, we have not gotten that. We have not seen a bad news bottom where the price action is opposite of the news. And I think the chance of getting that in this market is pretty slim. Could happen. But overall, I think the chance is not very high simply due to what the news factor is out there. This isn't something where all of a sudden one day is going to give us game-changing news on the downside, where things are going to get worse because of one day's news. What is the risk in this market? Well, the risk in this market is more of a gap up scenario. The risk in this market is more of a 2010 scenario where we had the flash crash, and 2 days later, China comes out and does a huge quantitative easing. We kind of had that a little bit last night. We kind of had where we have this monster down day, and then what happens? We have the U.S. come out, talk about some tax cuts, talk about some different things that can be done to stimulate the economy. How great is it? It's still in many ways ambiguous. We don't know how it's ultimately going to play out, but we have something here that is oftentimes seen in some of the bottoms, and that is we have a big down day with a massive sell into the close. We get people throwing their hands up in the air. They're just selling into the close. They go, I can't be a buyer. I've got to be a seller into the close. It's a panic sell, and that's what we saw yesterday, a hard sell into the close. And then what did we get this morning? We had a pretty substantial gap up. Now, I know, yes, the market gapped up and it sold off. So, oh, no, it means the bears aren't done. Well, my whole point in showing you these charts is to show you that even when the bottom is in, the bears aren't done. The bears are not going to be done. There will be sell-off days. There will be pullback days. Those will be natural. And whether we go back to 1987, 2010, or we go into 2007, the bears are going to have some days. We have margin calls. We have a lot of other things to contend with that are going to create some sell action. That is normal. But what is even more normal is to see that after a day like yesterday and a big gap up today, that bottom is in. Now, bottom in does not mean market go straight up, go buy anything because you're going to be fine and you're not going to have to deal with another sell-off and you're not going to have to deal with more fear elements in the market. No, you will. Those aren't going away. Those will be part of it. I can't stress that enough. But a strong sell into the close followed by a sizable gap up on a catalyst can oftentimes mark where the bottom is. We had that. We had that happen here. And it's one of the reasons why I look at the markets right now at this moment and I go, there's crash risk. There is significant risk of a big crash where, the market drops 13% tomorrow. That risk is there. That risk is palpable. That risk is not going to go away. But when we look at the 2-day price action here and how it's transpired, it's more indicative of a bottom being put in than of something further to sell. What tends to happen, though, is we get either a bad news reversal, bad news bottom, or we get this kind of big, heavy, slap down and gap back up. And they're not very good times for option traders. So I'm going to go into the market close here today with an opinion that market has come close to a bottom, knowing the crash risk is pretty high, so I have to be careful there. But knowing that from an option trader standpoint, still not a good time. It is still not a time to get in. Why? Look at the VIX. The VIX is at 60. What does that mean? That means the VIX at 50. It means that options are incredibly overpriced. It means that if we get a 30-point up day in the market tomorrow that doesn't have a 180-point swing in it, that options, calls, puts, they are going to get crushed. And the path of least resistance from most option values is down. That both calls and puts, you're going to be paying for time, which is normal. But if we move off of 50 on the VIX and we start to come down into normalized territories into the 20s, what's going to happen to options? They're going to get crushed. And in many cases, 50, 60, 70% without the stock even moving. So is it valuable as a option trader to go, well, bottom is in, let me go out and buy here because, there Jeff talked about a good sign that bottom's in? No. Oftentimes, the best options, they come as we start to see retests of a bottom, as we start to see, a little bit of volatility contraction come in. Because what do we know? The movement in stocks is not over. If you don't get the bottom, there's still going to be plenty movement in stocks. Chipotle Mexican Grill is still going to move a lot. This is a stock that even if bottom is in and there's a big update tomorrow, there will be plenty of further upside ahead if the bottom is in. There will be plenty of days of pullback that give opportunity to get in. And on those pullbacks, the options will be significantly cheaper. And so, yes, we could be in a V-shaped scenario where if you don't get in right now, you're going to be on the outside looking in forever. But that is not the norm. That is not how 1987 played out. That's not how 2007. That's not how 2009 played out. It's not how 2010, 11, 12. It's not how the pullback of 2015 played out. That's how small pullbacks play out. This is anything but a small pullback. So one of the biggest things that I want to see to really start to say, all right, I'm willing to go buy directional options more than just sell puts, because selling puts right now has some, you get really good premiums. And I sold a few puts here this morning, but it's one where you're going to have time. When you start to see those option values compress, normally the path of least resistance for the stock during those option compression times is up. So you can start to get in. You start to get that secondary move. You get the bounce, and then you get a secondary move that tends to be better for option traders, and you actually get better option appreciation than you get by calling the bottom and being in on the first big move up. And they don't always work out that way. Not every market is equal. They don't all react the same. But when it comes to the anatomy of a bottom, these are the time periods where you look and compare them to, not to these little shallow corrections that we have seen over the last several years. Thanks for hopping on. Have yourselves a fantastic day, and we'll talk to you tomorrow morning. Take care.